Thank you, Kristian, and welcome everyone. The backdrop is clear as we enter the industrialization of the energy transition. The United Nations Panel on Climate Change last month issued a dire warning. Global temperatures have already increased by approximately 1 degree. We are experiencing more climate-related crises than before, and issues with extreme weather is only expected to get worse. In short, we are on track to exhaust our emission targets 10 years earlier than previously predicted. However, there are positives as well. Since our last conference, the US has recommitted to the Paris Agreement, and countries representing 70% of global emissions have announced net zero targets. This is up from 0 in 2018. Looking at the capital markets, it is also positive to see a further acceleration of renewable investments despite the COVID pandemic last year. And increased investments will lead to renewables gaining market share over the next decade. While an expected annual growth rate of 12% is impressive, the pace will need to be further accelerated for the Paris targets to be achieved. And we are confident that a higher growth rate will be realized. The main reason for this is the force of capital markets. This is the most important point in my presentation. The cost of building new renewable capacity in Europe is cheaper than running existing natural gas and coal power plants. And the cost advantage will only increase as the energy transition scales and carbon prices are likely to further advance. Stable terms and enough capacity awards are the main issues now. Capital markets are ready to invest, and this does not depend on subsidies. The best proof of the impact of market forces can be seen in the world's most competitive market. US coal producers are in structural decline, with almost all companies experiencing financial challenges and more than 50 bankruptcies announced over the last decade. In sum, more than 100 gigawatts of capacity has been retired due to lower cost production from other energy sources. And the scale of change is large. 100 gigawatt is equivalent to more than 3 times the global installed capacity of offshore wind today. With this background, it is also exciting to take a look at the recent developments in China, today the world's largest polluter. For the first time, it is now many places in the country cheaper to build new renewable capacity than to run existing coal plants. This is a game changer, as it can create an environment for both high economic growth and renewable energy production. And this cost advantage is now also seen in places like India and Brazil. New markets and increased government targets on the back of reduced or removed subsidies are also a key reason for growth estimates being consistently revised upwards. Installed capacity of offshore wind in both 2030 and 2040 are now expected to be more than 80% higher than what most people viewed as highly optimistic estimates made only 4 years ago. In fact, we now expect to surpass the previous 2040 target before the end of this decade. In addition to higher renewables production, decarbonizing the energy market effectively means that we have to electrify as much as possible. Today, 20% of global energy consumption is covered by electricity. Many estimates that this has to increase to 60% or more for the Paris targets to be achieved. And that is not impossible. So let us talk about road transportation as an example. The sector today accounts for roughly 26 million barrels of oil demand per day, or one-fourth of global demand. After adjusting for the efficiency gains of electricity, this equals about 1,000 gigawatts of offshore wind capacity, or approximately 270 Dogger Bank developments with an investment need of about $2 trillion, 2 trillion euros. That's a lot of zeros, but to put it in perspective, it is not more than what has been invested in the oil and gas sector since 2016. Providing the energy needed to decarbonize road transportation is as such possible. Combined with electric vehicles soon expected to become the lowest cost alternative, also without subsidies, we expect major changes ahead. One thing renewables do not currently address is security of supply. It leads to increased volatility in electricity markets, as wind and sun conditions are not constant. Electricity is also a spot product. You need to transform it into static energy or hydrogen to store it for extended periods of time. Here, hydrocarbons today has an upper hand, and new innovative solutions will be needed in the future. In addition to the obvious need for new storage, we think digitalization can play a key part of this solution. As shown on the chart, current commodity prices are on average twice of the 5-year average at the moment. While there are many variables, we think years of low investments in traditional commodity markets are the key driver for the price appreciations seen this year. The best example of this is the oil market, where demand has rapidly returned to previous levels after the shock of the pandemic. At the same time, investments have continued to trend downwards since the oil price crash of 2014. This today creates super profit in the industry. And this is also the main driver for us forecasting even higher oil prices in the next couple of years. Still, we do not believe that E&P capex will increase materially due to uncertainty around long-term demand. This again supports higher near-term prices and sets the stage for what we believe could become the largest cash flow harvest the industry has ever seen, and cash flows are already at all-time high this year. The pricing of oil companies also indicate uncertainty around long-term demand. As shown to the left, ExxonMobil now trades at 10 times forward earnings. This is down from 16 times 5 years ago when the company traded at a premium to Ørsted. The higher required return is also shown through the dividend yield pricing. And while the industry clearly remains out of favor, we think the combination of low pricing, high direct returns, and a favorable commodity price outlook creates an attractive risk-reward going forward. Importantly, high commodity prices also accelerates the energy transition. This is achieved through an increased cost advantage of renewables in power generation and additional investment capacity that the oil industry increasingly uses to take part in the transformation. And we cannot talk about the energy transition without mentioning the hard-to-abate sectors. These industries are inherently more difficult to decarbonize and represent the largest challenge on the path to net zero, in our opinion. However, carbon capture represents an increasingly attractive solution. It is therefore great to see that we in Norway are developing the world's first capture facility at a cement plant. While this project depended on subsidies to be realized, we think carbon capture could become economical much sooner than most people think. The carbon price has doubled so far this year, and stricter regulations to force a change should be expected going forward. This will also be a key topic at the COP26 in November. In our opinion, the upcoming meeting in Glasgow later this year can become a new Paris moment. Governments will now need to address two concrete questions. How will you reach net zero by 2050? And how much will you reduce emissions by 2030? The UN is labeling the conference the world's best last chance to get climate change under control. and we expect ambitious targets to be announced in the period ahead. This will be positive for many of the sectors presenting here today and provides a good background for our energy conference. We will now take a short break before we continue with our keynote speakers that will discuss the opportunities created by the energy transition. Thank you.